Hey guys, my name is Bernardo Vallerino and I'm with KW Science. Today we have Jesse Mitchell. He is with Gold Financial and he is one of our ASL accessible partners. Hey Jesse, how are you?
Hello, Bernardo. How are you doing? Jesse Mitchell with Gold Financial here. I'm ready to help out and answer some questions today regarding the lending process.
Excellent. Well, I got basically three questions for you. Nothing difficult, but I think there are questions that kind of most first-time home buyers have. So the first question is actually about the first step, which is applying for a mortgage. So how is to apply for a mortgage?
It's actually very easy. Once a person has decided they want to look into buying a home and they need financing, they would simply go online. They could contact me directly by phone. They can go onto my website and they can fill out an application, or I can take that application over the phone. Once they have completed the application, and by that meaning you've looked at that application, you've answered all the questions on the application, and I do emphasize fill out as much of it as you can. If there's one or two things you can't, don't have access to, such as how much home you want to buy, we can always handle that later. If you run into a question while doing the application, you can reach out to me by call or text. That's fine. Once the application is completed, it's going to be reviewed for credit approval, which is the first half of the process, making sure that the customer has an adequate score to be approved for a loan. One of the things that I will touch on there is in the event that the score isn't sufficient at this time to move forward and get a loan, that's something we will discuss. I have a credit tool and I can go over some things and make suggestions on things that can help improve the credit score over a period of time. Go ahead.
What kind of information do you normally, does an applicant have to put into the application? About what kind of information are you looking for or is in the application?
No problem. So basic information, of course, your name, social security number, date of birth, your contact information, your income information. What is your job? What is your source of income? What is the amount of that income? Your asset information. Do you have a checking and savings account? For the application purposes, just need the name of the bank if you have a bank, whether you have a checking, savings, the amount that you have in those accounts. If you don't know that amount, then go with what you believe is your average amount that you have in the accounts. That's fine. There are a couple other questions that will be asked as far as demographics, things of that nature. Mm-hmm. So those are the basic things that you're going to put into the application itself.
Excellent. And you were talking about credit scores. So what kind of things, once you pull the credit, are you looking for in that credit report?
The key thing that we're going to look for in the credit report is what is the credit score. So on my end as a lender, I'm going to pull information from all three major bureaus, Experian, TransUnion, Equifax. Whatever the middle score of those three scores are is going to be the driver deciding the approval. And ultimately, once we get to that point, deciding what your rate on the loan would be. The items after that, or shall I say that compose the score, it just depends on what's on the credit report. So if you have anything that is causing your score to be lower than where you would like for it to be, sorry about that. We all want, 800 credit score.
Yeah.
If you don't have an 800 credit score, what is causing it to be a little bit lower than that? We're going to look at those things and see if there's something that can be done, whether it's paying down on some cards, looking at how much credit you actually have. How many lines of credit do you have? How many of those lines are positive as opposed to negative? Those are the things we would look at to see if there's any room or opportunity that could be used to bring your score up if needed. In some cases, the score may not really be as bad as some people may think, and it may be sufficient for them to move forward if they choose to do so.
Excellent. And do credit repair programs help in that case to get a credit score up, with say within 6 months to a year?
If the credit score is low enough, then yes. So if you were looking at, and I'll just kind of give an example, if you were looking at a score under a 600, then depending on how far it is under that 600, credit repair may be needed in order to deal with some things that are on the credit at a deeper level than what I would be able to do. I can make some suggestions to help bring it up, maybe say anywhere from 30, 40, 50, 60 points. If you need more than that, then that's where credit repair would come in handy. And yes, they can be very successful at doing that and setting a time frame in which they should be able to accomplish that.
Excellent. So if somebody's in a lease for, have 6 months left on the lease, or they do have bruised credit and they wanted to kind of get in the lease right now and then work on it for the next 12 months, you can still guide them. And on top of that, the assistance of the credit repair program could get them to obtaining a mortgage, possibly within 12 months, right?
That is correct. We could look at it to see what's needed. Again, on my end, if I can make a suggestion that would help them out, anything I would be able to suggest would be able to help the person out within roughly a month or two. If they needed more work than that, that's when they would go with the credit repair. But once that score is sufficient and where it needs to be, the next step after having credit approval obtained would be gaining documentation. So I would need income documents, which may be pay stubs, award letters. I would need bank statements, tax returns, W-2s, and we would need to complete a job verification. Once credit approval is achieved, there's an email that will go out that will list all of these items that are needed. Once those items are obtained, job verification is completed. At that point in time, we would be able to discuss exactly how much the person would be pre-approved for, how much money they would have to buy a house.
Excellent. So once you have all the paperwork in hand and you say you look great to purchase, then you're going to tell them how much they can qualify for. How do you come up with that number? How do you know how much kind of person qualify for?
Got you. It's basically going to be determined by debt to income, to be very honest with you. So debt is going to be taking into consideration any number of payments that is seen on the credit report, plus the new mortgage payment. Those two things are going to be considered the debt. And that total number is going to be literally divided by the amount of income that shows on the application. So based on the debt to income will determine how much money the person would qualify for based on how much they're able to maintain in their monthly payments.
Another thing that that I remember that might be part of the determination is how much money they currently have for down payment, for example. So they do have to show that they have a certain amount of down payment for the kind of house or mortgage they want to get, right? So
Correct.
would that be part of kind of your consideration of obtaining a qualification on the amount?
That is very correct. So if someone is looking to buy a home, and I'm going to give an example. If you're looking to buy a home that's, say, priced at $200,000, you do have what is called closing costs. Closing costs is the total amount that the customer, the person buying the house, would need to be able to bring to a closing table, that final part where you sign all the documents and get your keys for the house. The closing costs are your down payment plus other fees, such as your title fees, lawyer fees, money to build your escrow, such as your taxes and your insurance, things of that nature. If you were buying a house that was $200,000, your closing costs may run you an average of anywhere from $12,000 to $16,000 that you would need to be able to bring to the table. Now, with that being said, the first place we're going to look to see if the customer has the money to cover that would be their own checking and savings, which could include things such as your 401k. The next item or items that can be taken into account, if there's any money from, say, someone in the family who's willing to help you out in buying the home, that money may be accepted as what is called gift money. And it's going to be actually designated that way and documented that way to show that that's money given specifically for the sole purpose of buying the house with no strings attached. That can be accepted. Another source could be, if it's worked out in the contract, if the seller is willing to provide some money or contribute some money to help with the course of the sale, that money would be thrown in as well. So if there's gift money, if there is seller contribution, whatever's remaining from that amount is what the customer would have to bring to the table. One other possible source, if the person qualifies for it, would be down payment assistance. That is down payment assistance qualification is determined by where the person is going to be moving to, the location, as well as the household income. And that's something we would look at to see if a person would qualify.
And there's some guidelines for different kinds of assistance programs, right? So all assistance programs are not the same.
Correct. So each program has its conditions and requirements that will have to be met, and they will impact what a person may be able to do. In general, in a nutshell, I'll just say this as far as down payment assistance is concerned. It is a beautiful thing. If you're qualified for it, it can help you out. However, depending on where your debt to income ratio, which I mentioned earlier, how much debt you have over your income, the amount of loan you can get if you're using your own money is generally going to be higher than what down payment assistance will be, because most down payment assistance is going to ask you to bring in less debt into the situation. And the way you get to less debt is having a smaller mortgage payment, which means less money that you're using to purchase your home.
Correct. So not always down payment assistance program is the best way to go.
Correct. It's there if you need it. But remember, it does come again. This is somebody or entities giving you money that are going to have conditions that may make changes in what you are ultimately going to do.
Excellent. Excellent. And remember always, guys, that part of the things that we can do as realtors is help you negotiate some of those closing costs also in the deal. So even though you might be a little strapped with cash for your closing costs, always talk to us or to your realtors with your KW signed realtor, and we should be able to help you possibly with negotiating some of that money as well. Jesse, thank you so very much for taking this 5 minutes with us and to discuss kind of the basics of the first step, which is obtaining a mortgage. Once again, thank you.
Okay. And I know you'll include my information in the post. If anybody has any other questions, by all means, please reach out to us. But
yes, just go ahead and put any questions in the box, and we should be able to answer all those for you and get you to the right person. Thank you so much, everybody, and we'll see you soon. Bye.
Bye.